In this video, we're going to continue our discussion of technical analysis. And I guess if I wanted to leave one thing with you, the most important thing that I could tell you, and that is that the market leaves breadcrumbs. It tells you where it's been and where it's headed. And it leaves these breadcrumbs in a trail so that you know exactly where it's going. Now, it's not always totally accurate, but in the big picture of things, it can give you a pretty good clue of where it's headed. And I'm going to give you the two most important clues that you probably have never, ever heard before. Let's start out with this chart. Now, we've been looking at the Qs. We looked at some option samples for the Qs, but I'm going to take a look at the SPY. Because the SPY is probably one of the most popular traded online instruments. It's the S&P 500 ETF, and it's a highly traded vehicle. It's extremely liquid, and its options are extremely liquid as well. And if we take a look at the chart in front of you, it begins in approximately March of 1993. And it goes through 1995. So it's about a 2-year period that you have in front of you. Now, if just taking a look at this chart, you can tell just from a quick glance that this market is in an uptrend. When it started, I'm not sure. This is as far as back as this chart will go, about 20 years. Now, there's a couple of things that are interesting about this chart, and they're obvious about this chart. Number one is that it looks and appears to be the beginning of an uptrend through 1993 and 1994. There's one very important event on this chart. Can you pick it out? Well, if you mention this extremely high volume day in which it looks like a spinning top was created. And now that spinning top is not at the top of a trend, nor is it at the bottom of a trend. It's actually right in the middle of a trend. The market has basically been going sideways here for several months. All of a sudden, we get this huge volume spike at a price of approximately $34 on the SPY. There isn't a whole lot of action here, actually. There isn't a lot of movement here. The market looks like it went up a little bit, it went down a little bit, and it kind of closed in a very, very tight range. In fact, the open was at $33.94, and the close was at $34.05. So just about 11 cents difference between the open and close that day. However, the volume was gigantic compared to what we saw in the previous year and a half. The volume was very, very high. That gave us somewhat of a clue that something was different. We don't really know what was different, but something was different on that day than all the previous days that preceded it. So looking at the market is almost like being a detective. We want to try to look at patterns. We want to try to find the behavior of the market. That market is all it is math and psychology. Math and psychology. It's looking at the numbers, and it's looking at the psychology of the market at the time. This was back, this particular week happened during the week of June 1994. Now, this high volume week, remember we're on a weekly chart here, came after this huge decline in the previous week. And if you take a look at the market, you can see that it's actually declined starting back in January of 1994 through this period of June 27th, 1994. So the market for that year was actually a down market. Now, all of a sudden, we have this 1 week in which we get this huge uptick in volume. Very interesting. It really does pay to be a detective when it comes to looking at the market and analyzing the market. What happened during that week that maybe gave us some clue that in fact the market was ready to make a turn? That this, in fact, this volume, this high volume week was significant in some way. Well, let's take a look at the news from June 27th, 1994. This is from the LA Times, where the headline reads, "More pessimists are bearing down." One of the quotes that he uses from a Minneapolis investment firm says that we think we have moved into a bear market. Who's this research analyst at this investment group says, "We are probably in a bear market," concludes another veteran money manager at a mutual fund. So there was a lot of pessimism during that time. However, if we go down towards the bottom of the article, very interesting observation by Michael Burke from Investors Intelligence, who tracks bull and bear sentiment across 135 market newsletter writers. And he admits that the percentage of bullish newsletters is now only 27.2%. It's near the lowest reading since 1988. Now, in 1988, just after the stock market crash of 1997, you remember that there was a huge rally after 1997. It dipped a little bit back down again in 1988, but after that, the market roared higher. Burke wisely concludes that the gloom has become so overdone that we're getting close to a bottom in the market. While the bears pointing to sinking indexes in the Dow and the NASDAQ composite, Burke notes that a lot of stocks are holding up well above their April lows, which he views as a sign of the market getting ready to turn. Well, very interesting observation, because that's exactly what happened. And interestingly enough, after the decline from January into this low in April, you can tell that the largest spikes during that time came on days in which the market rallied. Even this particular day, had quite a bit of volume in which there was very little movement in the market. This particular day had a very large amount of volume in which the market hit a new low and then proceeded higher for that week.